Going live. Hello? अच्छा, letting people in here. Yes, started.
Let everyone join.
Yes. Hello, everyone. Can you hear us? Hello, can everybody hear us?
I think now it's went live. Hello, friends.
So start.
Hello, friends. Welcome to today's webinar on option buying. We'll just wait for 2 minutes. Let everyone settle down. Let everyone join. We'll start in 2 minutes. Hello, friends. Let me introduce to my team. Meet Jitendra Jain. You know him very well. He's master strategist, and he can think of 10 strategies at single point of time. That's his love for trading. I'm Yogesh Nanda. I do most of data crunching, backtesting of all the strategies. Meet Yogeshwar Pal. You know him very well. He's master option seller. He's grown his account from 5 lakhs to 1 crore in very short period of time. We have Janil Nanda, Janil Dedia with unmatchable execution skills, and a very disciplined intern we have Manek Agija. So welcome my team. I'll start with my presentation in some time. We'll stop sharing our videos because we don't want bandwidth to be consumed. So let presentation go as smooth as possible. Any cutoff of voice, you please put in chat box. We'll look into it. I'll start sharing my screen now. Yeah. Let's start with presentation. Let me start with today's objective of today's webinar. Objective of today's webinar is there is so much this thing to, people want to know about how option buying works in this world of option sellers where they run with 70% success rate, how we can be profitable with option buying. So purpose of today's webinar is to take you in the mind of the option buyer, his psychology and his thought process, how you can be profitable option buyer. Second thing is we have some big plans for 2021 in trading as well as the market education space. So we are, coming, we will be out with many more webinars, many more training programs. Third plan for 2021 is developing some executable strategies for retail traders, which you can, which they can, with some practice, they can execute directly into their capital. Fourth is focusing more on skill enhancement and learning for the traders. So we'll, this year many announcements.
It's not visible.
Yogesh ji?
He is not hitting share your screen.
Yogesh ji? Yeah.
Share your PPT. No, share screen you do. You did. Because PPT is not visible.
Now is it visible? Okay. Yeah. Sorry for interruption, guys. I was about to talk about how our today's presentation would be structured. One, I start with introduction, then technical setup, how to set up all the indicators in your Zerodha platform. What are the setup and rules for the system? What is money management and risk management plan? We'll cover many examples like how to take a trade, how to place a stop loss. We'll cover past historical example. Plus, as Jitendra sir said, last on 24th, he took 3 profitable trades in option buying. So we'll share how he took those trades with all the rules, how the topic we'll cover is compounding, how you can compound your capital in long term. And 7 is pitfalls, few things which you have to keep in mind while doing option buying. Or maybe what are, things which you need to be considered before going to option buying. So let's start. First thing is why you become an option trader. It's not to thrill or something, right? You need to make money. And definitely option is a thing where price is derived from your underlying. Plus there are many other factors which affect price, like, all Greeks, uh, gamma, theta, everything. So you have to keep those things in mind. How many cricket friends here? I think all of you must be cricket friends. So I'll relate, option buying with a cricket, just as a metaphor. First, you need to know who is your opponent. In option buying, your opponent is option seller, because whenever you make loss, that money is going into the pocket of option seller. So you need to know your opponent properly before, playing against him. So winning in an option game against option seller is like beating Australia on Australian pitches. because weekly expiry is the home ground of option seller, right? Because of the aggressive theta that coming in into option pricing, that is the reason you need to be. Just a second. Hello, hello. Are sir? Yeah. So like option buying is playing against Australia on Australian pitches. So let's understand what are the team. Let's understand the team of our opponent. They have a home ground advantage like Australians. So for option seller, weekly expiry is their home ground. So beating them in weekly expiry need really, thorough understanding and very disciplined approach. Then second thing is Australian team strong bowling line. So for option seller, that is theta. Theta is always working against option buyer, because whenever you buy, even sometime, many time, what happens, price is moving in your direction, but still you don't make that much money, or you don't make money at all. That is only because of theta. Option is a option price contains two things: intrinsic value and extrinsic value. Now extrinsic value is a theta which has to decay over a period of over the life of that option. So within a week, say 50 rupees, 100 rupees option has to go to zero if price don't become in the money. So that thing you have to keep in mind, because that is a decaying commodity. So every day its price deteriorates. Third thing is strong difference for Australian team, which is for option seller, is that delta. Like, you know how option sellers work. They don't only sell calls or puts, they sell straddles and strangles. So whenever they sell call, they have one put against it. If price moves up, call prices goes up, but to some extent it is compensated by fall in the price of the puts. So that's why they are relaxed. They are not bothered with small moves. So to make them jittery, bigger moves are required. So that's why, many times in small moves you don't make money. Fourth thing is that lower batting order of Australia. Now for option seller, their success rate, they got nearly 70% success rate, 70% plus. So that's the main key, because they are not bothered. They consistently keep on making money. So with small moves, small losses, they are not much concerned. Now just look at as I explained an example, just look at now option chart of option seller. These are the Greeks of the sellers. So if you
The screen is not visible.
it's shared, sir.
You can minimize it because we're getting a lot of requests. Now it's changing. Just keep it like this. Don't make it full screen.
Okay. Now is it visible? Is it visible now, sir? Just a second. So whenever they sell call and put together, that is straddle or strangle, their delta comes down very drastically. Now in this example, you can see the delta is just 17, which means for 100 points move in Nifty, uh, their straddle price will move by just 17 points, right? Because call and put compensate each other. They have second big advantage is theta. Every day 1500 is the theta which price will going to decay. So these are the two main guards. And look at option bias profile. Option bias, ATM option bias delta is say 58 or 50. So for every 100 rupees move against you, you will lose nearly 50 points. So that is much higher than option seller. So here, they always have an upper hand. And now, so how to beat them? For beating them on their home ground, we have to build very strong team of indicators. So we'll look at our indicators, our teammates, one by one. First is VWAP. Now, what is VWAP? VWAP is volume weighted average price, which means a average price for the day on which price average volume has taken place. You know, whole day at different prices, volumes is taking place, trades are taking place. If you multiply that by the volume and you take an average, that is the average price happen for that day, and that's the price at which writers have sold their calls or puts. So this is our key guard. If price is below VWAP, that means seller is comfortable, and if it's above VWAP, means seller price has gone up above its selling price. So to some extent, he is, in bit trap kind of situation, like the price he has sold at lower price, now price is above his selling price. So that's why VWAP we have to keep in mind. How to use it, we'll see in later slides. Let's just understand the indicators one by one. Our second player is RSI. Now RSI, as you know, is a momentum indicator. RSI is used to measure the magnitude of the recent price changes. So if price is moving at a faster pace, RSI will keep on increasing. And how to read RSI is best way to read is, many people read it wrongly, like, price is above 70, it is overbought. Price is below 30, it is oversold. That's not the right way to catch the momentum. Because when price crosses 60, that means price in the upside momentum. So many times what happens, even at above 70 levels, even in overbought levels, price keep on going up and RSI keep on extending, keep on stretching. So we have to look at, as above 60, RSI is in momentum, price is in momentum, and below 40, price is in downside momentum. These are the two rules we'll use. In below graph, you can see this is 13,500 put option chart, 5-minute chart. Look at when RSI, that is gray area, when RSI crossed above 60, look at the momentum in the option price, right? So whenever options RSI is above 60, that is not good for option seller. This we have to keep in mind, right? And look at the second box where RSI is below 40 and price is sliding down. Okay. So this is our second player. How to use it? We'll combine all the players together and form a team then. Third thing is volume. Now volume is quantity of instrument traded on the exchange. Higher the volume, more reliable the move, right? Why volume is important? Because many times what happens, at lower volume, price moves up, but those moves are not sustained because it's not supported by volumes. To price to make a substantial move, we need a larger participation. We need larger volumes. So that's why volume is a very key factor, and we'll look into it. You can see here the way volumes have increased, and look at the price moves here. Look at two arrows. From first arrow, price volume started rising, and look at third arrow, move from 260 to 400 because it's on higher volumes. Our fourth and important player is, like our captain, open interest. Let me explain what open interest is. Like in cash market, the way volume happens, in options and futures, it is tracked by open interest. Now, open interest means total number of outstanding derivative contract. For every contract, there is one buyer, one seller. So whenever they enter into a trade, buyer buys and seller sells, it is marked as one open interest. Okay. Now they are the price movers, because whenever any trading happens in option or future market, that they move the price. So these open interest we have to track very carefully. Now increase or decrease in open interest indicates option seller sentiments. How? I'll show you. You can see here what throughout the week option sellers do. They keep on selling options at different prices, and their open interest keep on increasing. And their open interest keeps on increasing. That shows that option sellers are selling options aggressively. But When they are trapped, what they do? When price moves against them, they have only option left is to exit from their position, which you can see in decreasing open interest. In given graph, you can see open interest at lower window. Look at lower window. Open interest is increasing. This green line is open interest and red line is average of open interest. How to use it? We'll show in our strategy slide. But just observe this chart. Price is moving sideways. Open interest is still going up. Now, when price started going up, price is above VWAP, it started going up. Open interest started decreasing. That means now option sellers are feeling the heat of price move. So they have only option left is to exit the position, which is seen by aggressive increase in price and aggressive decrease in open interest, which you can see on upside these candles are rising, and in lower pane you can see green line is falling, which means option sellers are now trapped and they're cutting their position. Okay, this is the way to read open interest. Now we have understood our individual players, their strength, and how we can use them in the team. Now we'll put them together, and how every player will contribute in our strategy. We'll understand that. So from open interest, what you have understood is when is best time to attack. Now you must have been observed when 2 or 3 wickets of Australian team falls, what Indian team do? They will bring in all the players very close. They will increase the position in slips. They will bring the third man, and they'll try to attack. They'll try to make. They will force batsmen to make some mistake. They can only do when opponent is trapped. Now in option seller's term, we can only attack option seller when he is trapped. Now, how we come to know he's trapped, and what are the situation when we know he's trapped? There are few parameters, like when normally sellers get trapped. First thing is when there is sudden gap up in the market. So next day, overnight option sellers have sold their position in last few days, but there is sudden gap up. So now they feel trapped because prices have opened beyond their entry price. So this is the first thing. Then when there is sudden breakout from a range, market is trading in a tight range and there is big breakout from that range with higher volumes. So that is the second condition, second situation when they are trapped. And third is when there is sudden IV spike in the market. Now what is IV spike is? IV is implied volatility, which tracks volatility priced in the option prices. So higher the IV will increase in IV will increase the option prices without increase in underlying price, right? So when IV increases, option prices go up. So this is the third thing when they are feel trapped. Now how to identify? We don't need to see anything else. Open interest is the best indicator. When he taps, what he does, he start exiting his position, which is seen by increasing decreasing open interest. So when open interest of any strike is decreasing, that means option seller is exiting. So that is the best indication of trap. And how we see it, we plot moving average, because on open interest line there are many ups and downs. So we need proper signal. So for signal, we put 20-day moving average on open interest chart, which will indicate when price open interest goes below 20-day moving average. That means cutting in options has started. Clear? I'll put in clearly in the rule, don't worry. So now let's combine our all players and their strength. So first player is RSI. When RSI is above 60, that means is in favor of buyer. So we will play only when RSI is above 60. Second is when option price is above VWAP, that is selling price of the option seller, it is in favor of option buyer. Third thing, there is huge volume in the candles say volume greater than 1.5 of the average volume. So that is the time when we think there is increased participation in the market and there are possibility of option seller getting trapped. Fourth is open interest. Condition is when open interest is declining and preferably below 20-day moving average of open interest. That means option seller is trapped. So these are the strengths we'll play on, and we'll combine all these parameters to get a most what you call it best possible trade. We are not going to take each and every trade. We need all the confirmation to take a trade. Now this is just an introduction. Okay. Trading is not only what to buy, when to, how much to buy. Trading is a jigsaw puzzle where there are many pieces. One is what to buy, what to sell, when to buy, how much to buy, what quantity you will buy, what initial stop loss you put, when you will book profit. There are many questions which you need to answer. So for that purpose, any trading, say option trading or cash trading, anything, you need properly defined plan in advance with all the rules possible. So how you design a strategy? So first you have to decide which instrument you will trade. It could be Nifty, Bank Nifty, stock, option, future. So in our case, it is options. Whether you will buy or sell. So in our case, we'll be buying. Strategy selection. So strategy will select call buy or call put depending on the signal we are getting. Now what expiry to select, what strike to select, when to enter, what quantity you will buy, stop loss, target profit, how to trail, how to react to black swan events. In our case, black swan event won't make much difference because we'll be trading intraday. Plus, our stop losses would be in the system. So any drastic move is not going to affect us much. So we are not bothered by black swan events. Now, key is to be a successful trader, you need to document all these rules and you have to make changes to suit those rules according to your style. We'll see to it later. So here I just finished my introduction, and second thing is technical setup. Here we'll understand how to set up chart setup on Zerodha. So for this purpose, we'll be using Zerodha's chart IQ setup, right? So for using that, first step is you have to on your Zerodha orders window, exactly on right hand side there is your ID would be there, your trading ID. You have to select there. You will see a pop-up where you have to select my profile. Once you select my profile, one big screen will open. So there are two options you have: chart IQ. You got two options: chart IQ and trading view. So we'll be using chart IQ. You have to select chart IQ. Now once you select it, you are set for using chart IQ. Now you have to come to your main screen where you have a watch list. So say in watch list, you have here a stock or maybe option price listed. So there is one option where you can see the three dots. If you click on that, you will get a pop-up, and from that pop-up you can select the pop-out chart option. So there is second option which is charts, and there you can see a box, blue box. If you click there, chart will pop out in a separate window, right? So you have to use that. So this way you are set with the chart. Now chart is there on your separate window. Now I'll show how to plot each and every indicator. I'll minimize this and I'll go to my. So once you click a pop-out chart, you will get this window. Are you able to see the chart, or your still presentation is there? Please, if someone can tell me. Okay. So on this chart, I'll show you each and every indicator how to plot. First thing, this is the way you can select your strike. So I'll select Nifty 13,500 put, right? So here is the chart. Then you have to select time frame from here. I select 5 minutes. Now my chart is set. Now we'll add individual studies. So for you have to go to studies. You will get this search in studies option. So first study is VWeb. You have to select this only VWeb. VWeb is plotted. Now again I'll go to same thing and I'll select RSI. So first option is RSI. RSI is plotted. Now we have to change RSI setting because default settings are 80 and 20. So we have to put overbought as 60 and oversold levels as 40. Select done. Now you can see gray area is marking. Whenever price goes below 40, it will be marked as a gray area. And when price goes above 60, it will be marked as a gray area. So this will show us clearly whether we are getting RSI signal or not. Our first indicator is set. Our Virat Kohli we have set. Now we'll go to Seva. Second is open interest. So same way, you have to select open interest. You can see green line is plotted. That is our open interest chart. Now I will add average.
Yogesh, can you zoom a bit? Can you zoom a bit? The screen is not clear.
This way? Is it right now, sir? So we have already plotted open interest. I'll plot moving average on open interest. So if you just click moving average here, you will get this window. So we have to select here period as 20. Okay. If you now click done, it will plot it on the price, but we don't want on price. We want on open interest. So here in field, you select OI. Now you can see moving average is plotted on the open interest. Correct? So this is right setup. I will go to our last one, volume. So same way again, volume, we have to select a volume chart. Volume is plotted. Now we need again moving average. So same way, search average, select moving average, period 20, and in field, you will select volume. Now you can see red line on volume chart. So this is the way we can plot all the indicators. Now our all indicators are plotted and this way chart look. Now you can just select, then you have to do one thing. You have to save this as a view. So every time you need not plot them. You save this as a, say, options 1. You save it. So next time when you open a chart, you have to just select here and select the view. So all the 4 indicators will be plotted automatically. Correct? Now we'll just move to our presentation back. Now this we finished how to plot all the indicators. Third part is strategy setup. Give it 1 minute. Let me have water. Now let's understand full setup. I cover each and every system related part here. So what we are going to use option chart and not the underlying chart. We are not using here Nifty or Bank Nifty chart. We will be plotting all the parameters on option chart. Say if you are trading call, put, then put that strike price, everything, and select the option chart. Time frame we'll be using is 5-minute chart. You can test it on different time frames depending on your preference. Say 3-minute, 10-minute, but backtest it properly, and that's fine. But we use normally 5-minute chart. Now let's go to the rules. When we will take a trade, right? So you have to observe both call and put charts, and wherever you are getting that signal, you will execute the trade. So if price going up, you will get signal in calls. If price is going down, you will get signal in puts. And rules are, we'll only execute trade when price is above VWAP. That is one rule. Second is, price is uptrending, that is moving away from VWAP. See, sometimes what happens, price is above VWAP, it's totally sideways. But we need price should move up. We need a momentum. So that is second rule. Price is moving away from VWAP. Third is, there is rise in volume, that is 1.5 to 2x of the average volume. And what is average volume? Average volume is when volume is about 20 SMA plotted on the volume chart. So that will come to know price volume is above its average. Fourth rule is, just a second, someone is saying this is not clear. Yeah. So fourth rule is, when RSI of the option chart is above 60, right? We need confirmation from all the signals, are all the 4 players. And fifth and very important rule is, OI is reducing and it is below 20 SMA on the OI chart. Correct? I'll repeat it once again. There are 4 rules. 5 rules. One is price above VWAP and it's trending up. That means from VWAP we are getting clear signal. Second is, volumes are rising and volumes are above its average by 1.5 or 2 times, which we get from 20 SMA on volume. Fourth, RSI is above 60. That means option pricing are in the momentum zone. We know plus 60 is a momentum zone. Fifth is, OI is reducing. That means option sellers are trapped and they are exiting, which we know by when OI comes below 20 SMA. And all the rules must be satisfied before taking entry. We will not be taking entry if any single of the rule is also not satisfied. So we need confirmation from all the 4 signals. Correct? I'll give you one example here. Now this is 13,500 call December. You can see in open, price is above VWAP, but RSI is below 40. Open interest is rising. So we will take a trade? No. Now go forward. Say at say 3 p.m. we get a signal from price moving above VWAP. Correct? And then later at few candles later we get a signal from RSI crossing 60 with rise in volume, and there is also signal from OI cutting its 20-day moving average. So we get all the 4 signals and see the movement in the price. So here we'll take an entry at 53. Now stop loss part I'll cover in next slide, stop loss and trailing and everything. But this is just to show that how we get an entry. That when all the 4 indicators are satisfied, we will take entry in call buy. Same thing is the put. If this is put chart, we follow the same rules. Price should be above VWAP. Volume is greater than 1.5 or 2x of moving average, past 20 days average. RSI above 60 and OI is below 20 SMA. Now, strike selection. So we have to monitor few strikes, say ATM, OTM on call side and ATM and OTM on put side. So wherever we get signal, we can trade that. I prefer to trade with ATM strikes only, or max I can do is first OTM. Reason is far OTM are not much sensitive to the price moves. So I need, strikes which are more sensitive. So for smaller moves, far OTM strikes won't move much. And when price fizzles down or maybe price comes down, they fall faster because of the theta. So prefer ATM or first OTM only. This works best in Nifty and Bank Nifty. So instrument side, choose Nifty or Bank Nifty, and expiry we'll select is monthly expiry, ATM or OTM. So in delta terms, you can select 0.5 to 0.3 delta. Don't go beyond that. If you are doing weekly expiry, so first condition is you start with monthly expiry. Once you develop expertise in monthly expiry, then only you move to weekly expiry. So in weekly expiry, I prefer first ITM options. I don't go for OTM in weekly because that theta decay is very fast. So I prefer deltas maybe between 0.5 to 0.7. So that is first in the money option, because that theta is less. But in OTM terms, theta is very far, very there's more theta and there's decay much faster. So in weekly expiries, prefer in the money options. In stocks, this works little differently. So it will need a little, a different treatment. So we maybe cover it later time, or you can, test on stocks. But we'll focus on just index here. That this is important note I like to put here. These are based on our experience. So please choose strike as per your personality and experience. So you just look at, what kind of options. Bank Nifty is very volatile. So many people won't digest the volatility of Bank Nifty. So they should go to Nifty only. In strike terms also, if you should prefer monthly expiry plus strike, you should go to ATM. So these are all, you have to choose as per your personality and your experience. See, one thing can't fit, for everyone. It will need a lot of practice and understanding. Now, second thing is stop loss and target. Say you get an entry in all the 4 parameters, you already enter the trade. Now, next question is where I put a stop loss. So stop loss will put this again. This is just indicative rule which works for us. So stop loss we put is 20% of the premium. Now this percentage and or previous swing low on the option chart. See, when you are on 5-minute option chart, say your entry price is 100. So 20% of that is 80. 20% of that is 20. So you can put from 100 rupees 20 point stop loss. So your stop loss level will come at 80. Or if you have swing low on option chart at 85, so you will select 85. So lower of closer of these two. So if it is 20%, then you select 80. But swing low is at 85, so you can select 85 level. So whichever is closer, we need. So logic here is our stop loss should be as small as possible. Correct. So we will select stop loss which is out of these two, whichever is closer. Keep as smaller stop loss as possible out of these two. In target terms, these are the trades where option seller is trapped and it is short covering rally. So in short covering rally, we can't have a targets. You don't know, how far price will go. So just keep RR based target, risk reward based targets, right? So say your stop loss is 20. So if you are getting 40 points, you get 1:2 risk reward. So you can book part profit booking there. Correct. So that is what RR risk reward based targets are. If you get 1:3, 1:4, you can book some more quantity. Or third thing is you can also use index chart. You can keep index chart. Say if you are trading on Nifty call, put a Nifty chart in front of you, and at major resistance or support levels, you can take part profit booking or exit from your option trade. I repeat again, targets. In target fund, you can keep risk reward based targets, or you can use index charts. So this is the, because targets are not quantifiable in options. So best use, you can use your judgment, or say you are getting 1:2, 1:3 trades, uh, you can book it. We'll cover, profit booking in our trailing part. Now here comes the trailing part, which is most crucial and most, this is the part where, your profitability will depend. How aggressively you are trailing, and how how many less times you are giving back your profit to the market. Correct. So important is locking in your profit, because option moves are very volatile. They move 50 rupees up, and in second minute they will fizzle out. They come back to their original moving price. So they are very volatile. So your trailing has to be strong. So how we do trailing, I'll just cover few rules. Again, here trading entirely depends on individual traders' risk appetite and trading style. Some may be, they are very fast. They trail one every five points. Some are, not that fast, or they are not that aggressive. So they can trail on candle basis. So I'll just share few our rules. Now, few indicative rules are: whenever you reach 1:1 risk reward, that is, whenever your say stop loss is 20 rupees and you are in profit of 20 rupees, you can trail your stop loss to cost. Now, whenever you reach 1:2 risk reward, say you entered with a 20 rupees stop loss and now you are at 40 rupees profit, you would like to lock in few profits. So you can book 1/3 quantity and trail balance to 1:1 risk reward. Correct? So in such a way, you should trail in balance also, you get 20 rupees. So in first 1/3 you got 40 rupees, and balance quantity you trail to 20 rupees profit. And third is, whenever you reach 1:3 or above, correct, you can 1/3 more quantity, and now you be aggressive in trailing. Trail candle to candle. So whenever one candle closes, you move your stop loss to close of that candle. I'll show this in example on 24th how we did trailing candle to candle. So don't worry. Now there is another way to trail, is once 1:2.5 or 1:1 risk reward is reached. Okay, so say your entry is 100, your stop loss is 20, and your price reaches 110 or 115, 120, whatever you decide. Post that point, for every 5 rupees move in your option price, you trail your stop loss by 5 rupees. How? I tell you. Say your price reach at you start at 100 rupees, your stop loss is 80 rupees. When price reaches 110, you move now from this point onward, you should move stop loss very aggressively. So from 1110, if you reach 115, you move your stop loss to 85. At 120, you move your stop loss to 90. 125, move your stop loss to 95. So that way, for every 5-point move in your uh, option price, you move your stop loss by 5 points. This is point to point trailing. So this is also another, good way to trail. So you have to, you can form, rules as per your appetite and your risk profile. So this is all about trailing. Now, many would say that this is very, subjective, or maybe very, what you can, discretionary trading. Whether it is profitable or not, how can we backtest or not? So just to, we did a random backtest. What we did, we did backtest on, say, Bank Nifty ATM call. We buy every day at 9:20 and we exit at 3:29. Okay, so we buy at start of the trading session and we end at the close of the trading session, and we keep stop loss of 60 points from our entry. So this is the rules. So every day we will enter and every day we'll exit. Next day again we will enter. So we did uh, backtest for, say, from 15th February, that is 1.5 years. So this random entry system also was profitable with 99,000 profit with success rate of 26%. Okay. So here 2 points I like to make. Even if with random entry we are profitable because of trailing, so with, say, few filters, with few logical filters, we can't we be profitable? And second thing, See, at 26% success rate, we are profitable in this system because of higher risk reward ratio. Say for one rupee risk, you are getting 3 rupees profit in this system. So because of higher risk reward, even at lower success rate, you are profitable. So say by using few filter, if you improve your success rate, can't we be profitable? So this is just to back, our hypothesis. Just option buying can be profitable. Yes, it can be profitable even with random entry. If it's profitable, so with few rules, few filtration, definitely it can be profitable. Now, here we come to end with major portion of our system, its rules, and I'll explain even logic behind every rule, logic behind every indicator, and how we'll combine all these indicators, how we'll trade, how we'll enter, how we'll put a stop loss. Now, major crucial part of any system is a money management and risk management. That is the answer to how much quantity you will buy. Correct? See, many people has a myth that option buying, you don't need any capital, because say ATM option of Nifty 100 rupees, you can buy just for 7,500 rupees. So for 7,500 rupees, you are able to enter. So you don't need any capital. With 10,000 rupees capital, also you can trade options. That is not the case, my friends. I'll tell you why. Because say 100 rupees option, if you buy at 100 and if your stop loss is hit at 70 rupees or 80 rupees, you lose 20% of your entry price. Okay. So in capital terms, if you have 10,000 capital and you buy say 100 rupees option for 7,500 rupees, and if you lose 20% of that, which is say 1,500, so which is nearly 15% on your capital of 10,000 rupees. Correct? So never measure your profitability or your returns in terms of the price of the option. Always link it to capital. So how? I'll just show you. See, there are two things of position sizing. One thing is fixed size. So in this, you will, and every time you get a trade, you will buy a fixed quantity. Okay. Say you are, so say one lot for every 1 lakh capital. So if you have 5 lakh capital, every time you get an entry, you will buy 5 lots. Correct? See, even amount invested for buying option would be much less. So for 100 rupees or say 200 rupees strike, you will be selling out only say 375 into 100. So 37,000 or 50,000 rupees. But capital, I use this for 5 lakhs. Rest capital is idle, but still I'll link it to capital to measure, to reduce the risk. If you trade one lot for 10,000 rupees, your volatility on capital would be too much high. See, even if you have 5 lakh capital, that doesn't mean you buy 50 lots, right? Because loss always would be in terms of percentage of capital and not the percentage of your premiums. So in this system, if I have a 5 lakh capital, I trade only 5 lots. I won't buy one extra lot. So it's up to you. You can decide one lot for 50,000. You can decide one lot for 1 lakh capital or 1 lakh 50,000 capital. That's up to your risk appetite. And here, position size remains constant always, irrespective of your entry price. Even if you buy 100 rupees option, then also you will buy 5 lots. Even if you buy 200 rupees option, your size would remain constant. So this is first method. Second method is here fixed risk method. Here we will fix our risk on per trade. Okay, say you have a 5 lakhs capital. So on every trade, max amount I will bet is 1% only. So that is 5,000 rupees. So 1% of 5 lakhs is 5,000. So every trade I'll take, every signal I get, I'll bet only 5,000 rupees. And we will derive our position based on our size and stop loss, based on our risk amount and stop loss. I'll show you this calculation. So in second method, we have a predefined stop loss. We have system determined position sizing linked to capital and stop loss. And objective here is to maximizing risk reward ratio. Now look at this example. Say you have 5 lakhs capital. Per trade risk you are taking is 1%. So per trade I am ready to lose 5,000 rupees. Now I have bought option of 100 rupees where stop loss is 80 rupees. So my stop loss is 20 rupees, correct? Now I'll do the backward calculation and I'll derive my position size from my risk amount. So my risk per trade is 5,000. Divide that by stop loss 20 rupees. So I'm getting 250. Now 250 is not a standard lot size. So I'll convert it to 225. Got it? Got my point? So in this trade, even if my stop loss is hit, I'll lose max is 5,000 and maximum 1% of my capital. So this is the best way for new traders. Okay, new traders can define that. So to lose your cap, if you bet only 1% on your capital, to lose your capital, you need 100 wrong trades in a row. That is not possible, right? So this will avoid risk of ruin. You know, many people complain, you know, in option buying, we lost say 40%, 50% of our capital. That is because they don't exercise proper position sizing and risk management. Now here's just two things. If you exercise, if you calculate your quantity this way and you adhere to your stop loss, no way you can lose your capital, you major portion of your capital, right? Some drawdowns are part of the system. So you have to accept that. But this is the best way to, you know, to do the position sizing. Now I come to second part is risk management. In option, say buying or selling, in option, if you don't manage your risk properly, you know, there is no way you can be profitable. So risk management, few risk management rules we follow are: one, never risk more than 2% of your capital on a single trade. Second, preferably play in monthly expiry. I've already explained the reason. If in weekly, be disciplined like, if you are trading in weekly, then be disciplined like a rock, because in weekly you can't, you know, trade loosely. Otherwise, theta decay will kill you. Third is, don't force trade on you. So if you don't get a signal from all the indicators, don't trade. If whole day you don't get a signal, don't trade. So option buyer has to trade like a sniper. You know what sniper does? Sniper, he sits there for maybe hours to wait for a perfect shot and then he take a shot. That's why he's called a sniper. Fourth is, don't trade weekly OTMs. Weekly OTMs never trade, especially on Wednesday and Thursday, because they are going to go zero in you know, in next 2 days. So never trade weekly OTMs. New traders start with monthly options. Do weekly only after profitable track record. 6. Stop loss has to be in the system. Mental stop losses don't work. So once you enter the trade, enter stop loss, keep on changing with every trailing, right? So this way only you will be, you know, able to develop a discipline, because otherwise you'll keep mental stop loss. Then your psychology will come in play and it will go to hope trade. Now after say it fall by 20 rupees, you'll say, if it recover 10 points, now I'll exit. It doesn't work that way. So it has to be in the system. Okay. Now here I covered the major part. Now we'll see few examples. I'll show you on chart, you know, how signals work and how they need to be monitored, and how you take an entry, and few live example which you have shared in your Telegram group. Just give me 1 minute break, friends.
So like by the time you take a break, I can show it them again.
Yeah, sure.
Okay, so like I'll share my screen. You can unshare your screen, and I'll show them like how to plot a chart. So let's see if you know it works as for all. Okay, thank you. So
Maybe share your screen.
Yeah, I'll share my screen.
Often if it is visible.
Okay. So can everybody see my screen? Yes. So okay, let's take this chart of December 30,000 call. So what we'll do is we'll take it and we'll pop it up. Yeah. If it is clear, let me know. If it's unclear, then also let me know. So okay. So what we'll do is we'll remove all the indicators. Okay. We will remove all the indicators. This is the personal chart that I've drawn for personal purpose. And this was the also live trade that we took. So the first what we can put is VWAP, right? So VWAP, as we all know, above VWAP it shows buying, below VWAP it shows selling, as Yogesh sir told us. Then we will take RSI. Okay, so you see RSI, I've taken it RSI for 14. You can experiment it with 10, 12, whatever number you are comfortable with. I hope the screen is clear. Uh, okay. Then we will take volume, and then one more we will take open interest. You can take them in any order, it doesn't matter. And then what we'll do is we'll add moving average. Moving average, 20 periods. The chart is in 5 minutes. Okay. And we will apply it on open interest. We'll again take one more moving average. We'll take 20 moving average and we'll apply it on volume. We'll take one more, which RSI settings you can make it as 60-40. You can see the gray area where it's visible. You can see each indicator as per the lighting. And then we will take one more moving average, which is not necessary, but I like to do it. Which is again take a period of 14 and plot it over RSI. Okay, you can change the variables. You can make it 3 minutes, 5 minutes as per your liking. You can also change indicators if you don't like any of these. And this is how we plot all the charts. Very simple. And this is how you do it. Okay, I'll increase the font size. Can you see the font size? Maybe because I'm on a bigger screen, you can see, how we add it. So this is the RSI, this is the volume, this is the open interest, and you track it. Correct. And the rules are very clear. Price should be above VWAP. RSI should be above 60. Volume should be 2x of average volume. That is what this red line is for. And open interest should go below its moving average, which shows that there should be an unwinding. It's pretty simple as that. Correct. So once you do this, you have your perfect setup. Okay. Which one? Okay, now I'll again repeat it. Yogesh was telling me to do it with big font. So I'll repeat it again. So you go to studies, you add as VWAP. It's simple. Studies, add open interest. Studies, add RSI. As I told you, it's the order doesn't matter. Studies, add volume. And again go to studies, add moving average. Moving average. Take 20 field, add it to open interest. Again studies, moving average, add it to 20, go to volume. I'll also share one tweet which shows this how to do it. done. And studies, again, one more moving average if you want. These are my favorite. Okay, I like to, one second. Okay, and I like to look at RSI. So I look at RSI. And these are simple settings if you want. And RSI should be 4060. Very simple. These are all subjective. You can make whatever you like it, whatever time frame you like it. We prefer 5 minutes chart and these settings, and we believe this works very well for us. So this is how it works for us. We don't use any pivot levels, or we don't do this. Only works in zero dha chart IQ. Rest you have to find out, guys. Okay. So talk to your broker if they don't do it. Ask them to do it. But all we do is this in zero dha. That's it. Okay. So I'll hand it over to Yogesh sir. And Yogesh sir, you can take it over. Yogesh sir?
Yeah.
Yes, sir. Please take it over.
Just are you able to see presentation?
Yes, we can see presentation.
Now we'll see some live examples and how this works in live market and how we have to track it. Now see this example. This is 13,700 put. Now this is just one day before when market on Monday we have seen a flash crash, right? There's a big fall in market. See how 13,700 put have behaved one day before and on the day of the fall. See, look at number one. This was first signal. We got signal on VWAP. Price is close above VWAP. If you look at RSI here, see there is some volume also, but look at RSI. RSI is not above 60. So we are not seeing any gray shaded area. So RSI is not giving signal. Our Virat Kohli is not ready. Look at open interest. Open interest is also trending up. It's not below 20 SMA. So even Dhoni is not ready. So we'll not take a trade here. Okay. Now come to next day. See number two. Now here also price went above VWAP. But you see volume is below its moving average. There is no signal from volume. There is no signal from RSI. But yes, OI is showing signal. But volume and RSI are saying we are not ready. So we'll skip this. Now see the third candle, this third part marked as 3. Here price is above VWAP. We can see big volume candles here above its moving average, say 2x. RSI is in gray shaded area and OI is already below its moving average. So all the 4 players are ready. Okay, so now we have to hit it. So here our entry was at 90 and stop loss you can put say 20% and previous swing low. So it will come to 72, but I'll kept as 70. So 20 rupees stop loss. Now see the move. Okay. Say here we get a 1.1:2 from so here we will start booking profit. Our first profit booking will come here. From here we start aggressive trailing because we are already into 1:3 profit here, more than that even. Here you can start trailing candle to candle. So say at 300 our stop loss could have been triggered, right? So at point to point trailing also your stop loss was never triggered till here. I'll repeat again. At third point you can see all the 4 conditions are satisfied. So our entry is 90. So our stop loss could be indicative 20% of the 90, that is 18 rupees or previous swing low. So I'll keep stop loss at 70. Price is going up. Price is uptrending. So I don't have to worry. OI is continuously reducing. Option sellers are trapped. Now it's moving up. I keep on trailing. Even with candle to candle trading also, we exit at 300 rupees. So in option buying, you keep in mind your success rates will be low. you might get 30, 40, 50%, below 50% success rate. But you have to manage your risk reward in such a way that one trade can compensate you for the 5 losing trades, right? So option buying only you can survive is by having bigger profits. We'll see a few more examples. See, this was post Monday fall. What we have seen is now on the day of fall, you won't get entry in calls because market is falling. So call price is already below RSI. So ऐसा नहीं होगा कि आपको दोनों signal दिखाएंगे, right? You will get either signal from call or put. You won't get signal from both. That is not possible. Now here on this day post big fall in market started recovering little bit, right? So whole day we don't get any signal. We directly get signal at this candle. You can see here. In first move, above VWAP, volume is there, but RSI is not ready, OI is not ready. Fine, we'll skip that. So after few candles, price is already above VWAP, trending up, volume started to built in, and you can see RSI just peaked above 60. So we get a signal from RSI, OI started dropping below VWAP, below its moving average. So we get 4 signal also. So all the 4 signals are there. So we enter this trade, say 53, we keep stop loss as per our rules and then keep on trailing. At least we won't make loss in this trade, right? See, any system trade, you take any system, only idea to survive is minimize your losses and maximize your profits. So once you are in profit, that trade, you can't drag it to loss, correct? You have to trail your stop loss. You can't sit at, initial stop loss still, even if price is moving up, you have to trail your stop loss. So at least in that trade, you don't lose much. Okay. Now one more example. This is 13,000 call. On this first green candle, this is big candle, you can see with volume, right? But we don't get any signal from, sorry, RSI no signal, and OI also above its moving average, above its moving average. So we skip this trade. On next day, if you see, we get signal from all the 4 participants. RSI above 40, price above VWAP, with volume, and OI below moving average. So option sellers are trapped. They started cutting their position. So this system is all about playing on weakness of the opponent. So option seller is only weak, only vulnerable when he is trapped. There is no other way you can, win against him. So wait for him to be vulnerable, then only you have to attack. And your these indicators will ensure that you take entry only when he is vulnerable, because we have made rules in such a way. 12,600 call. One more example. 13 November. RSI above moving average. RSI above 60. Open interest below its moving average. Volume is high with big candle. You take an entry with your desire, with your rule-based stop loss, and you can just ride it. One more example. See here. Price above VWAP, volume 2x of its 2x or 1.5x of its moving average, RSI above 60, and OI declining and below its moving average. You just make a on paper, you write it down. If you are trading this system, write it down on the paper, stick in front of you on your say board or somewhere, so it's always stays in front of you, so you don't make any mistake. Now here in this example, I'll show aggressive trailing, how the trailing works. And this trade Jitendra already posted live on Telegram as well as on Twitter. What happened on this day? Market opened gap up. Okay. So whatever option seller, they have sold their calls previous day, so they are trapped now. Overnight, because of gap up, they are trapped. So in first candle only, RSI went above 60. OI started declining in first candle only, and volume was very heavy volume. So he took entry in first candle only. You can see the green, hard line on the chart on first candle. So when price moved above, he moved his stop loss below the second candle. So on the close of the fifth candle, we moved stop loss to third candle. And then you can see we moved stop loss with candle to candle. Okay. After every big candle, we move stop loss to previous candle. So that way, entry was at say 400 and we got exit at say 650. So this one trade, can wipe out the losses of say last 7 trades, because here risk reward was more than 1:6, 1:7. So just wait for right opportunity, and you can. And same day, what happened? Price again came down to VWAP. All conditions are again met, and again price started going up. So we took a re-entry also on the same day. I'll show you trade by trade how we did it in later slide, but just I'm showing you, how trailing works. One more example. See here, price is whole day above VWAP. RSI is above 60. OI is also declining. So we take an entry here, but on this day, price didn't move. That happens. So we take a stop loss and we exit. But see what happened next day. In opening candle, it gave a trade, then it came down. Then again at say 1 p.m., we got one more signal. RSI above 60, OI declining, but volumes are very less here. So we, sellers are trapped here, but volumes are very less. So we may skip this trade. But this price moved, right? But because of our one indicator was not signaling, we skipped this trade, but price did move after, satisfying all other conditions. Now, one more example. See, with big candle, price moved above VWAP. Price is above VWAP. Volumes are decent, but there is no signal from RSI or OI. OI is still trending up. Okay, so till our Kohli and Dhoni don't signal, we don't take a trade. So we don't enter here. You can see price slided after that. So on this day, RSI saved our day. RSI and OI saved our day. So we did not enter this trade and we got saved. So this way, idea is showing example is, I want to stress upon one point. You just look for the most probable trade where all the indicators are satisfying. We may miss few trades, we may miss few good trades, but till indicators are not satisfied, we'll not take entry. Now let's take few failed trades also. It's not necessary that every time we get a signal we make money. Now look at here. In first candle only, all this indicators are satisfied. Price above VWAP with decent volume, RSI above 60, and OI is below moving average and declining. So we enter here at 79. We keep stop loss. So on this day, previous swing low was first candle low, and our stop loss is hit. Fine, we take it. But on same day, if you look at, we got another signal. Price above VWAP, volume is good, RSI above 60, but no signal from OI. So this trade was skipped. So one more example. Price is above VWAP, volumes are decent, RSI above 60, and even for some time, for small duration, OI came below moving average. So we get an entry here at 183. We keep a stop loss below VWAP and previous swing low. So our stop loss got hit at 163, and then price moved again back to above VWAP. So even you will find such trades for just 2-3 rupees your stop loss will get hit, but you have to follow the discipline. You can't, because you never know whether it will go much below your stop loss or it will reverse from stop loss. So we have to trade as per system. So be ready for these kind of days also. So you will say, operator is there in system watching your stop losses. It doesn't work that way. This is market. It's random moves. These are random moves. In some random moves, your stop loss can go, and so there's no one to blame. Just follow the system. Now we come to the important part, where I'll show the live trades with the screenshot of trades, how those trades went and what was the idea behind those trades. This is 24th December, right? Price open gap up. We got all the signals which I've already shown on charts. I'll show you the screenshots of the trades. So when all the signals satisfied at 9:19, if we took a trade at 426.89, because all conditions were satisfied. You can see the time here, 9:19. So when price moved at 9:25, so our initial stop loss was say stop loss say 390 or 395. So when price started moving, we moved immediately at 9:25. Our entry is 919. At 9:25, we moved our stop loss to cost because price moved up. Then again at 9:26, we moved stop loss to 440, then to 460, then to 470 because price was moving so fast, then to 500, then to 525, 540, 558, 576. Then ultimately our stop loss got hit at 630. You can see the final sell trade. So we entered at 990, we exited at 1020. So just 1 hour we were in trade and we